3 weeks ago, I logged into my credit card account to pay my bill. Before I could do anything else, a pop-up appeared. Full screen, friendly design, a little progress bar at the top, like I was in the middle of a process I'd already started. It said, "Help us serve you better. Update your annual income to make sure you're getting the most from your account." There was a form with my old income pre-filled, a box inviting me to enter my current number, a green button at the bottom that said update and continue. And I sat there for a second because I know exactly what that pop-up actually is. And it has absolutely nothing to do with serving me better. I closed it without entering anything, and here's why. And here's why you should too. Because every time you fill out one of those forms, you are handing a financial institution a weapon. Not because banks are evil, not because credit cards are inherently predatory, but because you are operating inside a system where your data is a resource, and you keep donating it for free while the other party uses it to extract maximum value from the relationship. Most people never think twice about it. The form appears. You fill it out, you move on. Income questions show up on applications like they're asking your phone number. The whole process is engineered to feel routine and required. It is neither. What I'm going to walk you through today is exactly what happens when you give a bank your income, the specific mechanics, the real math, the psychological manipulation behind the data collection process, and a clear framework for protecting yourself going forward. My name is Marcus, and I spend a lot of time thinking about the asymmetry in our relationships with financial institutions, what they know about us, what we know about them, and who that information gap benefits. Quick note, nothing in this video is financial advice. This is purely educational. I'm here to break down how the system actually works, so you can make better decisions on your own. Let's get into it. Here's the thing that irritates me most about this whole dynamic. And I want to start here because it reframes everything that comes after. Banks are generally not required to ask for your income. There's no federal law mandating that credit card companies know your salary. There's no regulation requiring your bank to have updated income information on file. They ask because they want to know. They ask because knowing helps them make more money from you. That distinction matters enormously. When something is legally required, you have to provide it, and that's that. When something is merely requested, you have a choice. Banks deliberately blur this line because informed customers make decisions that reduce bank profits. The form looks official. The request feels authoritative. The whole environment is designed to create compliance without ever technically requiring it. Think about the last time you applied for a credit. The application asked for your annual income. You entered it without thinking because why wouldn't you? Everyone asks for it. It seems standard, normal, expected. But here's what happened in the background the moment you submitted that number. An algorithm categorized you. Your income became a data point in a profile that will be used to determine not just whether you get approved, but what interest rate you'll pay, what credit limit you'll receive, what offers you'll be shown, how aggressively products will be marketed to you, and how the bank will treat you during the next economic downturn. You didn't apply for a credit card. You applied for a credit card and handed the bank a targeting profile at the same time. Let me walk through exactly what happens with income data once the bank has it, because the mechanics are genuinely fascinating and the consequences are not what most people expect. Credit limits, the most obvious use. Higher income generally means higher credit limits. This seems fair on the surface, and someone earning $150,000 can presumably handle more debt than someone earning $50,000. But here's what most people miss. Higher credit limits are not primarily in your interest. They are primarily in the bank's interest. Banks know that people with higher limits carry higher balances. It's one of the most consistent findings in consumer credit research. A $30,000 credit limit doesn't just mean you can spend more. It means you statistically will spend more. The bank isn't extending that limit as a reward for your financial success. They are giving you more capacity because customers with more capacity tend to use it and pay interest on it. The limit is not a compliment. It's a longer rope. Interest rate pricing. This is where income data gets used in ways that are genuinely counterintuitive. And I want you to really hear this. You would assume that higher income means lower interest rates. Higher earners are lower risk, right? The bank should reward them with better terms. The reality is more complicated than that. Banks don't just use income data to assess your risk level. They use it to assess your price sensitivity. And those are two very different things. Someone earning $200,000 is less likely to shop around for a better interest rate. They're less likely to notice the difference between 18% and 21%. They're less likely to bother switching providers over a few percentage points. The algorithm knows this. It adjusts accordingly. There's a practice in banking called ability to pay pricing. The logic is exactly what it sounds like. The more you can afford, the more we'll charge. Not because you're higher risk, but because you're less likely to push back. Studies have shown that affluent customers sometimes receive worse terms than they should because the algorithm correctly predicts they won't negotiate or switch. Your high income doesn't protect you from being overcharged. In some cases, it makes you more likely to be overcharged. The bank interprets your income as a signal that you can absorb worse terms without leaving. Marketing and upselling. The moment you reveal your income, you get sorted into a marketing bucket. High earners receive aggressive pitches for premium cards with annual fees in the $400 to $600 range. They see constant offers for personal loans, investment products, insurance packages. Every time you log in, you're walking through an obstacle course of upsells that have been calibrated specifically to your income bracket. Banks know that someone earning $180,000 is more likely to say yes to a $550 annual fee card than someone earning $60,000. They know that high earners often have more financial complexity, more accounts, more assets, more moving pieces, which creates more surface area for product sales. Lower income customers face a different version of this. Not premium offers, predatory ones. Balance transfer promotions with hidden fees. Personal loans at steep interest rates. Credit limit increases designed to enable overspending rather than accommodate genuine need. The targeting is precise because the data is precise. Income data persists. When you tell a credit card company your income, that information doesn't go away after your application is processed. It sits in your file. It gets used for decisions you'll never know about. It gets shared with affiliates and partners in ways that privacy policies technically permit, but most customers would never expect if they were asked directly. The income figure you entered 3 or 5 years ago might still be actively influencing how you're treated today. It may be factored into decisions about whether to increase your interest rate, reduce your credit limit, or close your account during periods of economic uncertainty. Banks have long institutional memories. Your data has a very long half-life. Here's the piece of this that I find most revealing about how the system actually works. Credit card companies generally do not verify the income you report on an application. They can't access your tax returns without your explicit permission. They can't see your pay stubs. They're relying entirely on what you tell them. Think about what that means. Banks want income data badly enough to ask for it on every application, to build it into every algorithm, to send persistent pop-up reminders asking you to update it, but they don't want it badly enough to actually verify whether it's accurate. If accurate income data were truly essential to their risk assessment, if they genuinely needed to know your real salary to make sound lending decisions, they would verify it. They have the ability to do so. They choose not to. The reason they don't verify it is that the income figure isn't primarily a risk assessment tool. It's a targeting tool. And for targeting purposes, what you believe you earn is almost as useful as what you actually earn, because it predicts your behavior and your price sensitivity just as well. They want the number because it gives the algorithm a starting point. Whether that starting point is perfectly accurate is less important to them than having any starting point at all. This tells you something important about your actual leverage in this relationship. Let's go back to that pop-up because I want to be precise about what it actually is. It is not a service improvement initiative. It is not a customer care program. It is a fresh data acquisition campaign disguised as customer service. Here's why fresh data specifically matters to them. Bank algorithms are optimized for recent information. A 3-year-old income figure produces significantly weaker algorithmic responses than an updated one. Stale data is less predictive. It doesn't trigger the same targeting cascades. Your profile gradually decays toward what banks call default treatment, which is actually fairly benign because the algorithm has less information to optimize against you. Banks know this. That's why they ask for updates so persistently. Every time you provide fresh data, you reset the clock. The algorithms wake back up. The targeting restarts. You become a newly optimized revenue target. Every single one of those pop-ups is asking you to re-volunteer for that. Process. When you close the pop-up without entering anything, nothing bad happens. Your account remains open, your credit score is unaffected, your ability to use the card is unchanged. The bank simply doesn't get the fresh data they wanted, and in 3 or 4 months, they'll ask again. You can close that one too. Let me tell you what happened to someone I know. She's a contractor with variable income. Some months $8,000, some months $15,000, depending on project load. When she applied for her credit card, she reported her income conservatively. She used her lower earning months as the baseline, which was accurate and legal and completely within her discretion. 2 years later, she received a credit limit increase notification. The bank asked her to update her income to process the increase. She entered her current earnings, which were substantially higher than what she'd reported on the original application. Within 3 months, everything changed. She started receiving constant calls about personal loan products. Her card offers shifted entirely toward high annual fee premium cards, her mailbox filled with balance transfer promotions. She'd been reclassified. What had been a quiet, functional banking relationship became an aggressive, ongoing sales campaign. She stopped updating her income after that. When pop-ups appeared, she closed them immediately. Over the next 6 months, as the algorithm ran out of fresh data, her profile gradually returned to default treatment. The calls slowed down. The premium pitches stopped. Her banking relationship went back to normal. The moment you give the algorithm new information to work with, it works with it. The only way to stop the optimization is to stop feeding it. Let me be precise about the legal landscape here, because there are situations where income disclosure is genuinely required and situations where it's entirely optional. Mortgage applications require income verification. This is federally mandated under qualified mortgage rules. Banks must confirm your ability to repay. You will provide pay stubs, tax returns, and employment verification. There's no getting around this, and frankly, you shouldn't want to. The absence of income verification in mortgage lending was a significant contributing factor to the 2008 financial crisis. Auto loans typically require income disclosure, though verification standards vary by lender and loan amount. Credit card applications ask for income, but as we just established, they don't verify it. You are required to provide an accurate answer. Providing false information on a credit application is fraud and it's illegal. But within the category of accurate answers, you have latitude. If you have variable income, you don't have to report your best month. If your income has multiple components, you don't have to include all of them. Report accurately, but answer what was asked rather than volunteering more than the question requires. Income update requests on existing accounts are entirely optional. Every single one. You are under zero legal obligation to update your income on a credit card you already have. The bank wants this information. They do not have a right to it. Close the pop-up. Credit limit increase requests. Decide whether you actually want the increase before you provide any information to get it. If you're satisfied with your current limit, the correct answer is to decline the request rather than providing income data to enable an increase you don't need. The bank is offering you more rope. You get to decide whether to take it. I want to be absolutely clear. I am not suggesting you lie about anything. Providing false information on a credit application is fraud. What I'm suggesting is that you understand the difference between lying and declining to volunteer. Those are not the same thing. Here's the thing about your relationship with a bank that I want you to really sit with. They know an enormous amount about you. Your complete spending history, your payment behavior, your debt levels, your geographic patterns, which merchants you visit, what time of day you spend money, whether you pay in full or carry a balance, whether your spending spikes before holidays, whether you're a price-sensitive consumer or a convenience buyer. They run sophisticated algorithms against all of this data continuously to extract maximum value from the relationship. And you can't see any of it. You don't see the algorithm. You don't see the categorization. You don't see how your data influences the terms you're being offered or the products being targeted at you. Meanwhile, you know almost nothing about their internal decision-making. You don't know why your interest rate was set where it was. You don't know what your customer profile looks like from their side. You don't know whether you're being treated as a premium customer or a value extract target. This is the fundamental asymmetry of the relationship. It's not equal, and it's not designed to be. In that context, refusing to volunteer additional information when you're not required to is not paranoia. It's a rational, proportionate response to an information imbalance that already tilts heavily in the other direction. The bank can still see your behavior, your payment history, your utilization rate, your account longevity. Those data points speak clearly and they speak loudly. If you pay on time, maintain low utilization, and keep your accounts open for years, your behavior builds a profile that serves you. That profile is built from your actions, not from forms you filled out. There's one more dimension to this that I want to address before we get to the tactical part, because I think it's the most overlooked piece of the whole thing. Banks have trained us to feel obligated when they ask for information. The request carries implicit authority. The form creates implied requirement. The progress bar in the pop-up makes it feel like you're in the middle of an official process that you need to complete. Most people comply not because they've thought through the implications, but because non-compliance feels awkward or risky. The first time you close an income update pop-up without filling it out, you might feel a small flutter of anxiety. Did I do something wrong? Is something going to happen to my account? Am I going to get flagged? Nothing happens. The bank doesn't know why you closed the pop-up. No flag appears. The account works exactly as it did before. And in a few months, another pop-up appears and you close that one too. And nothing happens again. What you discover over time is how much of the experience of banking is theater designed to produce compliance. The authoritative forms. the urgent update requests, the framing of optional data collection as customer service, the implied consequence of non-response. All of it is constructed to maximize the amount of data customers volunteer from customers who don't realize they have a choice. You have a choice. You've always had a choice. The bank just preferred that you didn't fully understand that. Let me make this concrete. Here's exactly how to handle these situations going forward. New credit card applications. Provide income information because it's effectively required for the approval process, but be deliberate about what you report. If you have variable income, use a conservative but accurate figure based on reliable earnings rather than your best month. Report accurately, but answer what was asked rather than volunteering everything you could technically include. Income update pop-ups on existing accounts. Close them every time. No penalty, no consequence. The bank wants the data. They don't have a right to it. You'll see the pop-up again in a few months. Close that one too. Credit limit increase offers. Before providing any information, ask yourself whether you actually want a higher limit. If you're carrying no balance and you're satisfied with your current limit, a higher limit provides no benefit to you. It only creates more capacity for debt accumulation. Decline the offer. Don't provide income data to enable something that doesn't serve your interests. Loan applications where income verification is required. Provide what's required. If they need tax returns, provide tax returns. If they ask for additional documentation beyond what the loan requires, ask why before providing it. Give them what they legally need and stop there. Phone calls asking to update your information. You can simply say you're not interested in providing that and end the call. The call ends. Your accounts remain open. Your credit score is unaffected. This happens far more often than you'd think, and there are no consequences. I want to be fair here and acknowledge when updating your income actually does serve you. If you want a higher credit limit and your income has grown substantially since your original application, providing updated income gives the bank a reason to approve the increase. If you're applying for a new loan and a higher stated income genuinely improves your approval odds, disclosure serves your interests in that specific moment. If you're requesting a rate reduction and income information supports your case, providing it can work in your favor. The principle isn't never tell banks anything. The principle is intentionality. Update your income when doing so benefits you. Decline to update when it benefits the bank more than it benefits you. Make a conscious decision rather than reflexively filling out every form that appears in front of you. The key question is simple. Who asked for this information and who benefits when they have it? If the bank asked and the bank primarily benefits, you have your answer. So the next time that income update pop-up appears, and it will appear probably within the next few months, if you have a credit card, you'll know exactly what's happening. The bank wants fresh ammunition for algorithms that optimize their profit from your account. They're asking nicely, because asking nicely is more effective than asking directly. They've disguised a data acquisition campaign as a customer service initiative because most people don't question things framed as customer service. Close the pop-up, your account will function normally. Your credit score will be unaffected. The bank will ask again eventually. Close that one too. Let your payment history speak for you. Let your utilization rate speak for you. Let your years of consistent behavior speak for you. That's data they already have, and it already tells the story of who you are as a borrower without you volunteering a single additional number. You've been handing financial institutions information they use against you. Now you know you don't have to. If this changed how you think about your relationship with banks, hit that like button and subscribe, because this is what I do every week. Drop a comment and let me know. Have you ever noticed your banking experience shift after updating your income? I want to hear what happened. See you in the next one.